Question 321. Which of the following is a kind of promissory note? A. Straight note. B. Fixed term note. C. Installment notes. D. Both A and C. Correct answer is D. Both A and C. A promissory note is a written promise to repay a specific sum of money, known as the principal, along with interest, according to agreed upon terms and a defined schedule. Various types of promissory notes exist, each characterized by its unique repayment structure. Two common kinds are the straight note and the installment note. A straight note, also referred to as an interest-only note, features a repayment plan where the borrower makes periodic payments covering only the interest accrued on the principal balance throughout the loan's duration. The entire original loan amount, or principal, remains outstanding until the very end of the loan term, at which point it becomes due in a single, large, balloon payment. This type of note is often used for shorter-term financing or in situations where the borrower anticipates being able to repay the principal from a specific future event. In contrast, an installment note involves regular, periodic payments that encompass both a portion of the principal and the accrued interest. With each payment, the outstanding principal balance is gradually reduced over the life of the loan. Installment notes can be further categorized. A fully amortized note is structured so that the regular payments, made consistently over the loan term, will completely pay off both the principal and all the interest by the final payment date. A partially amortized note also includes principal and interest in its regular payments but does not fully pay off the loan by the end of the term, resulting in a remaining principal balance that must be paid as a final balloon payment. Question 322. Once a tenant has vacated leased premises, his security deposit should be returned by the landlord in A. 10 days, B. 21 days, C. 1 month, D. There is no deadline for returning the deposit. Correct answer is B. 21 days. In California, after a tenant has vacated the premises, the landlord must return the security deposit to the tenant, along with an itemized statement of deductions, if any, within 21 days. If the deposit or portion of the deposit is not returned, the landlord must send the ex-tenant a written explanation as to why. Question 323. All listings, deposit receipts, and trust account records must be retained by a real estate broker for A. 2 years, B. 5 years, C. 10 years, D. None of the above. Correct answer is D. None of the above. According to California real estate law, Business and Professions Code Section 10148 requires real estate brokers to keep important transaction records. These include listings and deposit receipts. Trust account records must also be kept. The retention period is 3 years from the date of the closing of the transaction or from the date of the listing if the transaction is not consummated, except those relating to mortgage loan or securities brokerage, which must be held onto for 4 years. Question 324. Real property built up alongside a river is acquired through A. Accession, B. Escheat, C. Grant deed, D. Quiet title action. Correct answer is A. Accession. Escheat is the legal process by which property reverts to the state when an owner dies without a will and has no legal heirs. This is not related to the natural buildup of land by a river. A grant deed is a legal instrument used to transfer ownership of real property from one party to another through a sale or gift. It's a voluntary transfer, not a natural acquisition. A quiet title action is a legal proceeding to establish clear ownership of real property, especially when there is a dispute or cloud on the title. It's a legal remedy, not a method of acquiring land through natural processes. In real property law, accession refers to the acquisition of title to additional land or improvements to land by natural or artificial means. In the context of a river, the gradual accumulation of soil, sediment, or other natural deposits along the bank is called alluvion. This newly formed land becomes part of the existing property through the process of accession. Question 325. Which of these four terms does not fit with the others? A. Offer. B. Consideration. C. Deed. D. Acceptance. Correct answer is C. Deed. Offer, consideration, and acceptance are all essential elements required for the formation of a contract. An offer is a proposal to enter into an agreement. Acceptance is the agreement to the terms of the offer. And consideration is something of value exchanged between the parties. Deed, on the other hand, is a legal document that transfers ownership of real property from one party to another. While a deed might be the result of a real estate contract, it is the instrument of conveyance, not a fundamental element in the initial formation of the agreement itself. Question 326. An easement created by use of property without the permission of the owner is called A. Prescriptive easement. B. Implied easement. C. Involuntary easement. D. Statutory easement. Correct answer is a prescriptive easement. Involuntary easement is not a standard legal term for a type of easement. Easements are generally considered either voluntary, created by agreement, or involuntary, created by law or use. An implied easement is created by law based on the presumed intent of the parties involved in a property transfer. It often arises when a property is divided and a prior use was evident. While statutes can regulate the creation and enforcement of easements, statutory easement isn't a primary classification based on the method of creation. Prescriptive easements are recognized and defined by statutes, but the key is the unauthorized use. Prescriptive easement is created when someone uses another person's property openly, notoriously, continuously, and hostilely, without the owner's permission, for a specific period of time defined by state law. This required use period varies by state, but it typically spans several years. It's similar to adverse possession, but instead of gaining ownership, the user gains the right to use a portion of the property. Question 327. A real estate licensee sells property to a young married couple but later learns they are both 17 years of age. This transaction could be described as A. Valid. B. Void. C. Voidable. D. Unenforceable. Correct answer is A. Valid. According to California Family Code Section 7002, a person under 18 years old is an emancipated minor if they have entered into a valid marriage, whether or not the marriage has been dissolved. Therefore, since the young couple is married, they are considered emancipated minors under California law and have the legal capacity to enter into a real estate transaction. In this case, the transaction would be considered valid. Question 328. Which of these actions can be legally taken by a minor without prior approval of the court? A. Have their real property sold by a guardian. B. Provide a power of attorney sufficient to encumber their real property. C. Obtain real property via inheritance or gift. D. Both A and C. Correct answer is C. Obtain real property via inheritance or gift. Minors are generally not competent to manage or sell real property on their own. In most cases, court approval would be required for a guardian to sell a minor's real property. A power of attorney allows someone to designate another person to act on their behalf. Since minors are not considered legally competent to manage real estate, they typically cannot grant a power of attorney to encumber, put a lien on, their real property. Inheritance and gift laws are designed to allow the transfer of property wealth across generations. While a minor might not be able to manage the property themselves, a guardian can be appointed to oversee its care and ensure it benefits the minor. Question 329. When the title to property is given to the lender as a guarantee against the repayment of a loan, but the borrower keeps physical possession of the property, it is called A. A promissory note, B. A land contract, C. Hypothecation, D. A trust deed. Correct answer is C. Hypothecation. A promissory note is a written promise to repay a loan, but it doesn't involve transferring title to property. A land contract is an agreement to sell real estate in the future, with ownership typically transferring upon full payment. It doesn't necessarily involve using the property as security for a loan. A trust deed is similar to a mortgage, where title is transferred to a trustee as security for the loan. However, in some states, a trust deed might involve the lender taking possession of the property upon default, which isn't the case in hypothecation. Hypothecation is a legal concept where a borrower pledges an asset, like real estate, as collateral for a loan but retains physical possession of the asset. The lender gains a security interest in the property, meaning they can seize and sell it if the borrower defaults on the loan. Question 330. Josh is a board member of two corporations which both make and market motor oil. He does not disclose this dual membership to anyone. If Josh is subsequently sued for breaching his fiduciary duties, the court would likely base its ruling on that. Antitrust rules are concerned with preventing anti-competitive behavior and monopolies. While Josh's dual role could potentially lead to antitrust concerns, the immediate issue of his failure to disclose and the resulting potential conflict of interest falls squarely under fiduciary duties. The duty of fair dealing generally applies to transactions between the fiduciary and the beneficiary. While Josh's actions might involve unfair dealing, the primary breach stems from his obligation to be loyal and transparent to each corporation he serves. Duty of implied impartiality is not a standard recognized fiduciary duty in corporate law. The core duties are typically loyalty, care, and obedience. While impartiality might be a desirable trait in some situations, the fundamental issue here is the undisclosed conflict of interest, which violates the duty of loyalty. A key fiduciary duty owed by board members to the corporation they serve is the duty of loyalty. This duty requires them to act in the best interests of the corporation and not to place their personal interests or the interests of another entity above the corporation's interests. Failing to disclose a dual membership on the boards of two competing companies directly implicates the duty of loyalty. Josh's position with both corporations creates a potential conflict of interest, as decisions made at one company could benefit or harm the other. His lack of disclosure prevents the boards from assessing and managing this conflict. Therefore, the court will primarily focus on whether Josh breached his duty of loyalty by failing to disclose his dual board membership, which created a clear potential conflict of interest.